This is the Millennials in Multifamily podcast, brought to you by Kronos Investment Partners. We interview industry experts to unlock key information that will help young professionals break into the multifamily world in order to create long-term and short-term wealth. If you enjoyed the show, please head over to iTunes and leave a rating and written review so we can reach more listeners.
Thank you for joining us on today's episode of the Millennials in Multifamily podcast. I'm your host, John Stober, with my co-host, Fritz Ritter. And today we have Chris Salarno on to talk about how he went from rockstar real estate agent to crushing it as a multifamily syndicator at his company, QC Capital. Now, we often hear multifamily is a team sport, but what makes Chris so unique is that he started off entirely on his own. He did everything from sourcing deals, raising money, underwriting, managing investors, and asset management for the first year he was in business. He credits much of his success to thinking big and having a positive mindset. And as you'll hear, he's just getting started. Chris, thank you so much for joining us on today's episode of our podcast. Could you just go into a little bit more on your background and how you got into multifamily real estate?
Yeah, great question. I get asked that a lot, and thank you for having me. I'm super excited to add value to all of your listeners. So I started out in the single-family industry, selling single-family real estate here in the Charlotte area. Very quickly gained a success track record, which landed me in the position of operating the number one team in the Carolinas. From that, I was able to make them 46% profitable in 1 year compared to their 3 years of just being stagnant with no growth. And I felt like I hit a ceiling. I started really networking with the top people in the nation who are team owners for residential. And I just saw how they were running their business. And I told myself I hit a ceiling. So I then realized that when you play the game Monopoly, you don't broker real estate. So I said, okay, well, that's a light bulb that went off. So I said, I need to buy real estate to really build alter wealth. And I said to myself, let's go back to 2008, 2012. What asset class was the strongest? It was multifamily real estate. Even though we have this coronavirus going on currently right now, Walker & Dunlap said the number one asset class to have in this time is what? Multifamily real estate, because it's a necessity. We need shelter. That's where we're at right now, is shelter. So I realized that very quickly. So I said, that's the field I'm going to be an expert in and grow a large company. So I decided to really start studying it, listen to podcasts, YouTube videos, you name it, reading books. And I came across at a meetup a gentleman, and I heard his success. And I asked him, I said, you have to have a coach, because I coached in the real estate industry. And he said, it's Joe Fairless. So I said, really? I never knew he coached. I listened to his podcast. I said, I want him. So I ended up hiring him. So I'm in his personal private mentorship group. So he's an advisor to our company. And within 7 months, we were able to acquire a little over $40 million and 364 units. So we were very excited about that. I definitely believe, really networking at a very high level has projected us into the multifamily space. And we just look back, and this year for 2020, our goal is a minimum of 100 million assets under management.
Wow, 40 million in your first 7 months. Could you just talk about that first deal and any of the challenges and hurdles you had to overcome to get that to the finish line?
Yeah, great question. So when it comes to your first deal, and especially in the syndication realm, the most difficult part is really putting the puzzles together. I like to say you have a bag of puzzle pieces, and when you get your first deal, you have to dump them out and put them together. And when it's your first deal, you're missing some pieces. So it's always good to have an experienced operator that is willing to partner with you so they can bring those pieces to the table. So the biggest thing is when you raise capital for your own deal, it can be extremely difficult. I always say, whatever you think you can raise, cut it in half, because life happens. I mean, look what's happened in the stock market. I had a potential investor reach out to me on Facebook earlier this week, and he said, I wish I liquidated all my stocks in fourth quarter of last year, but I didn't, and now I'm down. So I can't invest into a syndication. So the most difficult part, I would say, is definitely making sure you have a good property manager, making sure that you have all the equity lined up and raising the equity, ensuring that your due diligence process is very thorough, and making sure that there's not a ton of deferred maintenance, because that's going to definitely kill you through the first couple months. So yeah, that's definitely some life lessons that I've learned with my first one.
So how did you find all your team members? What did that kind of look like?
Yeah, great question. So when it comes to finding team members, I'm a big believer of just letting it organically happen. An example that I always give is that when you meet someone for the first time at the bar, you're not going to go ahead and marry her the first night. You guys are going to get to know each other and then marry, down the road. And that's how it is with a business partnership. You're not going to meet someone and say, oh, we're going to be business partners the first time you meet them. You're going to build that relationships with them. You're going to see if you guys work good together. Then you're going to go ahead and go into business together. So the individuals that actually are on our company or within our company, they actually found me. And they found a way to add value to me first before I even was asked or, was seeking it. I'm a big believer of adding value to others and not asking for anything in return, because the universe, I believe in laws of attraction. It's going to come back to me. If you treat people good, people are going to treat you good. And they actually added value to the company, which after a couple times, I then popped up that question, hey, I think it'd be a good fit if, you just joined us. And they all were very excited. They're very happy with our growth. They're very excited to be a part of this company at the very beginning, as they know what I have in store with the vision in the next 5 to 10 years. So I'm super excited about it.
It sounds like, though, they joined your company after you had acquired a few properties.
Yes, yeah. So they joined after we had a few properties under our belt.
So those first few properties, were you doing everything by yourself?
Yeah. So just like when you're doing a startup or when you're an entrepreneur, you do everything. You do the underwriting, you do interviewing, property management. You are, ensuring that the audit reports are getting done. You're talking to the attorney to ensure that the loan docs are right and the lender and all that. Yeah. So first couple, doing everything myself, and then it's definitely been we just submitted an LOI yesterday on a large property, and it's been just a wonderful weight off the shoulders where I could just leverage, their strengths, which has definitely helped us and definitely will help us grow substantially this year. So that's just been very helpful.
So Chris, doing everything yourself sounds very difficult, right? You're wearing a lot of hats. What size was that first deal you were able to take down all on your own?
Yeah, great question. So the first deal was a 44 unit. It was off market. We do not look to go below 100 units anymore. So it was a 44 unit off market. And then after that, it was 144 and 174. So we look to acquire over 100 units, primarily B assets.
So why the shift to over 100 units?
Numbers, economy of scale. I mean, it's 44, you're doing the same amount of work that you would be doing for a 300 unit apartment complex. I mean, and it's that 44 will probably be a lot more painful than a 300 unit, and no one's going to get paid more than a 300 unit, but it just makes sense to go bigger. So that's why we won't look at anything under 100. I had a broker come to me, it was sometime this week, I think it was Tuesday. He said, we have a great 60 unit off market. I said, I don't want it. I said, feel free to send it to me. I'll forward it to a couple people who I know who likes that type of unit count. But for us, it doesn't fit it.
I was going to say, do you find a lot of competition with those bigger unit counts? We've actually opened it up to lower unit counts because not a lot of people are going after them.
Yeah. So I do find a lot of competition. The past 2 deals we lost out to funds paying cash. I have found that it's a ton of competition in the space. But if you know me personally, and all the individuals who work for me know that I work Monday through Friday more than 12 hours. I work a lot, and they know I don't back down. And I don't like to lose. That's one thing I do not like. So we lost out twice to funds coming in paying cash. So the third time, I got with some other business partners here in the area, and I said, well, instead of us losing out, we're going to go ahead and create a fund. So here, we're going into second quarter. So second quarter, we should have a fund up and running, around a $250 million fund that will be able to, we feel very confidently by the end of the year, have it fully funded and deploy that into multifamily.
So how has your strategy changed with the fund as opposed to just doing a regular syndication where you're putting the property under contract and raising equity from passive investors?
Yeah, great question. So when it comes to the fund structure, say you're a seller and say I came to you and I said, hey, I have a fund, John, and here's the proof of funds. We're ready to close. I can put 500,000, a million hard. I can even pay cash for the property. Once I close on the property, sell it to another entity for no gains, and then keep the property and then get my proceeds and throw financing on it. Or I can refinance it after 6 to 9 months and get some of the proceeds back and then keep the property still for our remaining of that business plan. Or someone else who comes along and says, hey, John, I'm going to syndicate the property. I'm just going to raise money from friends and family. And if it's a $10 million raise, I'm going to do that in less than 3 weeks. Which one would you feel more comfortable going with?
Oh, definitely the fund.
Correct. That's why I've lost out. So, and even with that, I've even took it a step further on the second round is to submit a proof of funds of a commitment letter that a equity group has committed to investing alongside of us of 5.1 million and a commitment letter and a proof of funds, and we still lost out. So I pulled out everything and we lost. So the next thing is to create a fund. So that's what we're doing. But that's, in my opinion, a great way to go, targeting these larger assets. But yes, like you said, extremely competitive. You just have to structure the deal correctly and ensure that your numbers are underwritten properly for the property to get the deal.
Do you think the fund is a more advanced move, like once you have a very good track record, or do you think somebody could start out with a fund?
So I think anyone can start out with a fund. We're getting a special software that is able to source equity providers who invest into a fund, and they invest anywhere from 50, 60, $100 million into a fund as commitments. And there's a way to filter it where you can find LP investors that will only invest as an LP in a first-time fund, and that they're open to investing in a first-time fund. So that's extremely helpful because you can build those relationships with them. But when you do create a fund, I definitely highly recommend partnering with someone who has a fund experience, because it's always easy to fall back on. Because number one thing, these large fund managers, before writing a $50, $60 million check, they're going to say, well, what's your experience managing a fund? Now I can fall on the experience of operating businesses and what I've done so far in the track record we are able to acquire. But when it comes to a fund, I'm gaining all my knowledge right now, but the individual who is willing to partner with me and us go together into creating this fund, he has a $25 million and $100 million track record of a fund. So that will be very easy to just fall back on.
Is that somebody you had to find, or was he already part of your team?
So that was an individual that was selling a property. It was like a 91 units here in Charlotte, and I was in best and final, and he didn't pick my offer. He picked someone else. And that was about a year ago. And surprisingly, they're large. They own over 7,000 units here in the Southeast. And surprisingly, people just kept telling him that, hey, you need to get in contact with Chris. I think you guys would be good together. And people were telling me, hey, I think you need to get in contact. His name's John. You need to get in contact with John. I think you guys could really do big things. And we finally met up at I was at the IMN conference in Atlanta. We met up there and we were like, let's grab dinner. And we all grabbed dinner and we hit it off from there. And I talk to him once a day now, and we meet about once or twice a week discussing this fund. But that will probably get ramped up to about 3 to 4 times a week as we really get close to getting into it.
So with these large funds, though, the fund is going to have such a large position in your property. Are they requiring you to adapt or change your business at all?
No, they're only LP investors. So you're thinking of institutions. Institutions wants to change everything. These individuals are just LP investors. They just want a return on their investment.
And so are there any risks that you need to look out for when you're starting one of these funds?
When it comes to, there's risk in everything. You definitely want to make sure you hire legal counsel. And that's huge, because you want to make sure when you're creating a fund, you're in that fund, you're allocating a certain amount to, for example, okay, say we're creating a $300 million fund. For example, $100 million will be allocated to Class B assets, and then $200 million is going to be allocated to Class A assets. You can't use 150 million to Class B. You have to only use 100 million to Class B, unless you have in there that you're allowed to allocate a fund to fund or any other thing. But so it's really just making sure your legal counsel understands how you want the fund structured and how the ownership and the management of that fund is structured before you get off running. But your first fund will cost you anywhere from 40 to 80,000, depending on who you use and what you do. So it's very important to ensure that you have all your ducks in a row before you go ahead and, make sure you pay someone that much to ensure that you have the correct fund up and running.
Now, would that be a regular SEC lawyer?
Yeah. A regular SEC attorney should definitely understand how to create a fund. But we use a couple here with myself and the other company. We have 2 attorneys that we like a lot that we'll be going back and forth to see before we hire them which one we should go with.
So I think a lot of our audience is younger. They're younger listeners. So $40,000 to $80,000 is a hefty chunk of change. Do you have any tips or strategies that you could provide them to potentially get a fund started if they're not flush with cash?
Great question. I would say don't go you could go a fund route. I've seen it done before. You can go a fund route if that's something you want. Before you do it, educate yourself. Listen to YouTube, read books on funds, Google funds, get a great understanding of it, because I don't want someone to go and create a fund they're going to, either partner with someone and then they're going to go try to talk to someone and they don't know how to speak the fund the lingo. Because when we are partnering with, for example, a retirement fund for a state or for a city's retirement fund, and they're going to write a $60 million check, they're going to know if we don't know our stuff, because they're dealing with other individuals that they're investing with and who have large funds as well. So I would say gain the education. And when you do that, find out who has created a fund anywhere from 10 to 100 million and partner with them. Find a way to add value. If you're going to be the acquisitions guy to find deals, or if you're going to underwrite the deals, find a way, some way. Everyone needs some way to add value to their business. Find a way to add value to them, and that can help you offset that cost. But before that, I would go the syndication route, because I think that would be extremely helpful, where you can do that with no money down.
What is your role now? You used to do it all yourself, and you brought all these partners on that you say you're able to lean on their experience. What is kind of your role now in your company?
My role now is I obviously oversee everything on all operations and asset management of the assets we own, or let me say we have ownership of. So I oversee all operations and asset management. When it comes to really my day-to-day operations, it's building very strong relationships with investors and large investors to invest alongside of us into the entity. And I really, when you bring someone aboard, you have to give them trust. You have to really let them do their job. So I ensure that, up front, they know the expectations that I have. They know that my goals for the company, our mission statement, our vision for the company, and where we want to take it. So their work ethic has to align with that, or they wouldn't be within our company. But you really have to give them that trust. So that's the oversee of everything, asset management of everything. I also oversee acquisitions, because the relationships I've already built, they're reaching out to me directly. And even though they reach out to me directly, I CC my acquisition specialist and I say, look, for example, if the broker's name's John, I say, John, please meet Ian. Ian's our acquisition specialist. Go ahead and send him all the off-market or on-market deals that you have. Anything major or important that you really want to discuss, don't hesitate. You can reach out to me directly, and then we can discuss it. But on that phone call, I have Ian on there. And that's the same way with our underwriter. Yesterday was extremely hectic. We had over 10 to 15 phone calls with lenders, and I ensured that, I had Elijah on and I let him talk most of the time, because that's his role. That's what he specializes in, and I give that to him. I don't want to step on his toes. That's what he knows best. So I let him speak most of the time. If I have any questions, I'll chime in, but I want all the lenders to know that's who they need to go to, is our underwriter.
So speaking of acquisitions and asset management, with coronavirus exploding in the United States in the last month or so, how are you changing your strategy right now?
for us changing our strategy, we're working extremely closely with our property managers to really get a count of who got affected in our assets. As of right now, everything looks very good, but we're working extremely closely with our property managers to find who got affected. And then if they did find who got affected, we're coming up with strategic ways to ensure that they can either pay on time. If they can't, then pay on a weekly basis.
And then from an acquisition standpoint, are you still actively buying or are you waiting out to see what happens?
No, we're all very actively buying right now. We just submitted an LOI and we have another deal that we like a lot that we're going to get. So yeah, we're actively buying, and no matter what market cycle, if there's a good deal out there, someone's dying, unfortunately, someone is getting a divorce, someone is, ending a business partnership where they want to sell the property, someone's partnering with an institution who says, I think we should sell, and they sell. Something's happening, and that's why I love real estate. So we're always buying. We are always buying good deals, and good deals are hard to come by, but fortunately we found a couple that we're pursuing right now currently. I think with how this market is that with this virus, a lot of people lost money, and I was just talking to an investor about this. A lot of people lost money in the stock market. So what they're going to do is when this rebounds, they're going to come to the multifamily sector. Why? Because the multifamily sector is the strongest asset class among all the other asset classes right now during this situation, the same during 2008 and 2012. So you're going to see a ton of capital. We already saw it in 2019, but you're going to see even more capital come once this is over, which is then going to draw the prices up. And then you're going to see a lower cap rate. So we're all seeing in the Carolinas a 4.5 to 5.5 cap rate. You're going to start to see that go lower because everyone's going to bring the prices up because they want to park their money somewhere.
I can definitely see that happening too, because retail and office, I think, is going to get hit really hard with this virus.
Retail's in a recession, in my opinion. I'm seeing it, or I saw it way before this virus coming.
But I think this virus is going to just speed up that process too.
I agree.
We're going to adapt and we're going to start working more remotely, in my opinion, and the demand for that is going to drop. And like you said, it's all going to flow into multifamily because people always need a place to live.
That's right.
Are you struggling to understand how to underwrite multifamily properties? Hi, I'm John Stober, and I completely understand your problem. I thought underwriting would come naturally to me due to my background in finance and accounting. But I quickly found out that there aren't a lot of resources that cover this subject. I had no idea whether what I was doing was right, wrong, or just original. I don't want you to have to pick up little nuggets here and there like I did. So I wrote an ebook called How to Analyze Big Apartment Buildings and Make Them Feel Small that puts together all the pieces of the puzzle. We're also giving away a deal analyzer with the ebook, and they're both completely free. Don't wait as long as I did to start chasing financial freedom. Go to bit.ly/underwriting ebook and get your free copy today. So let's go back. Speaking of acquisitions, though, I wanted to go back to when you were first acquiring your first property. I mean, you're a pretty young guy. So how did you initially sell yourself to those brokers before you had a track record and a team?
Yeah, great question. So this was a year ago. So I only founded QC February 1st, 2019. So we're only 1 year old. So we're growing very quickly. So when it comes to multifamily, I used to be a broker. So I leveraged that. And when you sell any type of product you sell, the number one thing you want to do when you sell someone is you want to build relationship with them first. I don't talk business first when it comes to me meeting a broker. I talk about their personal life, how they're doing, all that, and I let them bring up the property. That's same with an investor. So I leveraged my experience of being a broker, and I just built great relationships with them, letting them know I used to be a broker. I understand where you're coming from, really digging in and building a personal one-on-one relationship. But that's helped me, one, get a lot of off-market deals and get a lot of deals that are presented to us. So I think that's very important, is find a way to add value to them and find a way to build a strong relationship with them.
And then speaking of the investors, was that just the same role where you developed relationships, found ways to add value with them, and that way they were confident in the deals that you were pursuing?
Very much so, yeah. The main investor really he knew me for about 4 years, and he knows I know real estate. That's what he knows. He knows that it's all about real estate. He knows if anything goes on, even in the stock market, because I do watch it. He reaches out to me and asks questions. So about 4 years ago, we've built a strong connection, and I was able to then show him the beautiful light of multifamily, and then it just started compiling there. I definitely leveraged social media at a very high level. The call from the investor just before we got on here, she found me off social media and wants to connect in person and used to live here. So I leverage that at a very high level by adding content and adding value to people.
I love that. That's definitely a nugget that you're leveraging social media too. Just all of us here are pretty young, and that's an advantage that we have over people who are older and they're not as active on social media or they don't believe in its use. So
I agree.
It feels like you're using your age to your advantage and not as a crutch.
Correct. Yes, I'm definitely using it to my advantage. Once we create this fund, we will be targeting larger capital stacks. So I'm very excited to see how that plays out when I meet with those individuals.
I wanted to know on the acquisition side, have you changed your criteria with this coronavirus? I know some people are going only after B assets and maybe a little bit less heavier value adds. Have you guys done anything like strategy wise?
Yeah, that's good. So we focus very heavily on B assets and A minus assets, and we've always focused on that. So we haven't had any issue, and there's no reason for us to change our criteria.
Why B and A minus? Everyone I hear right now is saying go for C. It's the most recession proof, and you're kind of going against the grain with that.
Well, yeah, I'm going against the grain with that because your C assets are really, if you look at it, what type of demographic? They're the minimum wage or anywhere from $10 to $20, $15 an hour. Who's getting impacted the hardest right now?
The C tenants.
Correct. Yeah. So I'm really big about demographic and location. So primarily B and A assets have great locations and great demographics. When it comes to C and D, normally those are not in a good location, which location matters when it comes to something to this magnitude that we're dealing with.
So with you being in such a competitive market in Charlotte and going after some higher end assets, does that affect the returns that you're offering your investors at all?
It definitely does not affect the returns that we're offering to potential investors. When it comes to, focusing on these assets, like I said, we're going to see lower IRRs because there's going to be a fluctuation of capital that's going to be poured into the market. And when that happens, there's going to be lower interest rates. People are going to want to pay more for the property. So you're going to start to see the IRR creep down. But, even if you're getting a 10% IRR, that's still better. Well, obviously, it's better than anything in the stock market right now. But if you get a 10% IRR, that's phenomenal. That's great. Take it compared to a 15 or 18. I think a lot of individuals got spoiled between 13 and 16 because they were achieving 15, 20, 30, 25% IRR. And then now they're like, well, we want 18 or we want 15. We're like, well, now the IRR is between 11 to 14. So we're going to see the IRR creep down. But no, that has not made an issue into our underwriting.
When you're in such a strong core market too, going after core assets, I mean, what you can offer is safety and stability as opposed to someone who's buying C assets in a tertiary market. They may be able to have the 20% IRR on paper, but how is that thing going to perform right now when you don't have strong economic drivers in the area? So I think that's a great point. And overlooked too.
You're right. Yeah. Very good.
Chris, have you always invested in Charlotte alone?
No, all of the Carolinas. So we focus on Charlotte, Raleigh, Greenville, South Carolina, and Charleston, South Carolina. We are looking into Atlanta, Orlando, and Dallas, but Dallas is really not heavily on our radar. We are slowly looking into the South Florida markets as well, Fort Lauderdale, as I'm from South Florida. So we're looking in Fort Lauderdale, Aventura, Miami, those markets, because we do know that it's strong markets. Everyone's moving down South Florida. They've always been moving down to South Florida. So those are some other markets we're slowly looking into. But right now, we're heavily embedded in the Carolinas.
So as you move outside of the Carolinas in your own backyard, how are you building your systems? Because now you can't drive to the property and kind of have your own touch on it like you could if it's a 30-minute drive away.
No, yeah, you're right. So when it comes to, building systems out like that, it's very important to, make trips down there. And really your big brokers in the Carolinas are Cushman, there's CBRE, there's JLL. Those are the big brokers I've seen, Newmark, Knight Frank. So to build relationships with those brokers, I always say if you're looking to build a relationship with someone, what you're going to want to do is you're going to want to get a recommendation or an introduction to that individual, because your relationship's going to be stronger. And the reason why is that if I gave you an introduction to a friend, that friend trusts me. They trust my judgment. So they're going to be more open to speaking to you, and they're not going to have a shield, which everyone has a shield when we first meet someone. But our goal that we've already implemented is having those brokers that we know very well here in the Carolinas give us those introductions down there. So when we go down there, we have coffee, we build relationships with them, we tour assets, and that's how we're going to get our foot into the market. As we grow, we will end up having an acquisition specialist for each state to just focus on those states, and that's focusing on their one thing with those brokers.
That's an awesome tip. You really are the king of networking and developing relationships, because I haven't heard that one before. So as you build out your management systems, I know you're using third-party management, but how does that change as well when you're not a 30-minute drive away?
Yeah, definitely. So I always talk to the brokers. Brokers know who the good management companies are and who are not the good management companies. So when you're building those relationships with brokers, I always say, give me your top 3 or top 5 property management companies. And then I start to reach out to them. Once I reach out to them, I ask them for their references. Hey, give me 2 to 3 of your owners that you know in this area that you manage. Now you got the owner's information. And you can do that and try to get owner information that way, but that's not my goal. My goal is to build relationships with the property management company. So I build strong relationships with them because, and even here in the Carolinas, is that the property management company, about 70 to 80% will know before the seller wants to sell the property. The property management is going to prepare the property to be marketed. So when you are building strong relationships with the property management company, when they get that call and say, okay, we're thinking of selling, that property management company is going to say, well, I do know a great company, QC Capital. They're looking to acquire more assets in this area. Can I pass you their information? You can go ahead and just talk to them, because instead of go through this hassle, you may just be able to go one-on-one. Why is that in benefit of the property manager? Because if the property manager refers me a deal, I'm keeping that property manager in that property. I'm not going to kick them out and put a new property manager in. That's why you build good relationships with good property management company, but you keep them in the property. So it's a benefit to them because they're going to make more money in the long term, and they're not going to get kicked out, because I would say the majority of the people who acquire assets end up putting a new management staff in there, if not, right away within the next 6 to 8 months. So that's key.
Again, building relationships with people and finding ways to add value. Love it.
All about it.
As far as managing the property management company, what are some tips and strategies you have for that?
Yeah, managing the property management company, it definitely can be very difficult, because the business plan that you have for that property, if the property management company does not understand and are on the same page, then it can be extremely difficult and the property can fail. So I think it's very important to make sure everyone's on the same page. We do weekly calls with our property management companies. Every Monday, we do a call with them to ensure that if there's anything that came up, they can let us know, to ensure things we like, we don't like, to just see how the property's performing. Sometimes the call's 10 minutes. Everything's going good. Occupancy's good. No evictions, boom. Okay, we're good. Sometimes the call's an hour. So it all depends, but we always set an hour time frame just in case if we need to take that up. But I think it's extremely important to have at least weekly calls with your property management company, and especially with this virus going around right now, you need to make sure you're talking to them twice a week.
So, Chris, what are some KPIs that you guys go over in those weekly calls? What are you looking for?
Yeah, so it all depends on the property, obviously, but we definitely want to know occupancy. We want to know if we have a waiting list for any properties. If we have any properties for lease, we want to ensure how many showings we've had, how many applicants have we had, what is the traction on apartments.com and all websites, what's the traction on our own personal website to the property, are we getting reviews? Reviews are huge. I know when I go to a restaurant, I check on reviews. Even with hotels, I check reviews. We all do. So are we getting reviews? reviews. And then we're going to talk about the maintenance. How many work orders are we getting on a weekly basis? Okay. What is the response time to get those done? Are we getting reviews from those tenants that, yes, we got them done very quickly and they were satisfied with them? Okay. Then depending on the size of the property, are we doing any weekly or monthly giveaways, or events like movie night or, bark in the park or, something like that. Breakfast for all the tenants, have donuts and coffee out there so when they're driving out, you can give it to them. What are we doing on a monthly basis to ensure that the tenants feel welcome and that they feel home? So those are just some of the things that we do to ensure that we're going the extra mile as the operators for that property to ensure that we're going to get top dollar when we sell.
And so I've seen some of your videos on Instagram. I know you're rehabbing a lot of your apartment units. Could you talk about how you're managing that? Are you using a general contractor, or is that also something that the property manager is overseeing?
Yeah, great question. It depends on the size of the property. Larger properties, you're going to have a property manager who's always on site, so they're mainly going to oversee everything, and that's something that you talk to on your call about the renovation process. But depending on who you hire and what type of company you hire for the renovation process, you do have the property management company if they're large enough. They'll have a renovation crew that actually will do it. You just got to make sure it aligns with your budget. There's other renovation crews out there that you can hire that will manage everything, and then you can oversee by also having weekly calls with them, flying out there. I know if we definitely acquire a property in Florida, and if I'm currently living in Charlotte at that time, who knows, I may move down there. But if we are currently living in Charlotte, I will fly down there for about a week once we first acquire that property, maybe a month if I have to ensure that our renovation process is getting kicked off, making sure that the on-site property manager feels comfortable and that everything's rolling, where then I can slowly step away. But when we get to that point, I will hire someone within QC Capital to have that job duty who does have a strong construction background.
Chris, when you're making your renovation plans, is there anything that's an absolute deal killer when you're doing that initial walkthrough?
Not necessarily an absolute deal killer. I mean, we definitely look from aluminum wiring to poly pipes. Those are pain in the rear end. So we look to see if those property has that, if it's been remediated or not. But we focus really right now on units that are 90s or newer. We really don't like to go below 90s. We'll maybe do the 85s, but it has to be in a sweet location, sweet spot. But mainly it's over the 90s that we're focused on. But no, it's not absolute a deal killer. But, we're not looking to go in there and spend 15, 20 grand per unit. We're looking to spend anywhere from 4 to 10 grand per unit to get them fully turned. But when it comes to our underwriting, I love our underwriter. He's designed a special calculation into our underwriting sheet that tells us what units we need to renovate first based off of what they are currently getting for rent and what our pro forma is. And it calculates our ROI based off of that. So it tells us what units we need to renovate first and get on the market so we get the highest ROI starting out. So that's been extremely helpful when, going in doing these properties.
That's awesome. That's an awesome tool to have in an underwriting model.
Yeah, he's great.
I mean, you're going after newer product, 1990s and newer. Are you saying like polybutylene is not a deal killer for you? Because I know it's common in properties that were constructed around that time, but it can really add a lot of CapEx to your budget. So are there any deal killers?
Yeah, no, really no deal killers. I say aluminum wiring would be, a red flag that we may go in, we may not go in. But we have some properties that have that poly in it, which we don't mind. But we do, budget for that just in case if anything goes wrong. But so we do budget for that.
So I wanted to get a little bit into your mindset. Personally, it's really inspiring seeing someone so young having so much success in this business. What do you credit the most with this incredible growth you've had over the past year? What do you think is different about your mentality than other people our age?
When it comes to mindset, I always say if we all went to the military right now, the first week would be one of the toughest weeks for us because they would tear our mind down mentally and build it up into a soldier. That's what you need to do with whatever career you're in. You need to tear it down mentally. I don't care who's in your family. I don't care who's closest to you. You got to cut negativity out, number one. Anything on my social media is always positivity. Facebook now, everyone's blowing up negativity, but if you look at all my posts, it's all positive. Instagram's always positive. So I surround myself with positive people. I've cut out even some family members that are negative. You may have to do that, you may not, but you need to build your mind up into a positive mind, into a mind that's motivating, because as an entrepreneur, you're not having a boss wake you up at 8 a.m. You're waking yourself up at 8 a.m. And you got to get up, you got to get to work, you got to, create stuff. It's not like you're going to get slapped on your desk with a handful of papers. Make sure you do this by the end of the month, or you need to get these done. No, you're creating that. So to have that mindset, it's extremely important to build it down and build it back up with positivity. And I think once you build it up with that positivity, and you'll start to build that unstoppable mindset. But it comes down to your goals. What are your goals? If your goals are to make $10,000 a month, okay, in my opinion, those are very small goals, but you can easily achieve that. Those are your goals. So I don't like to knock anyone's goals. So go out and achieve it. That's great. But if your goal's to make 10 million a month, well, you got to wake up at 5 a.m. You got to be disciplined. You have to have a positive attitude. You have to have that energy to keep you going, keep you pushing, to create these ideas, to grow a large company where you are able to then achieve that certain status. So I say, really, if you're building it, tear your brain down, build it back up into the career you want to build, connect with people who are positive, cut all the negative people out, and just pour yourself with information about that career, about positivity, and you will then slowly start to build that mindset up to where it's just a machine and it's unstoppable. Where I've had someone who I thought was a good friend of mine come to me and say, you may not want to tell people your goals because it just kind of sounds like you're crazy. And I said, well, sometimes individuals who hear my goals can't think as big as I can. So it's not for everybody, but thank you for your opinion, and I'm going to achieve them, and you'll see me when I do.
The crazy ones are the ones who make the most impact too.
Look at Elon Musk. He's crazy, Yeah. But they make the most impact and they change the world in a good way normally. But, when it comes to it, it's having a strong mindset and that positivity, and do not let anyone get in front of you. You just can't.
Chris, something I think that goes hand in hand with mindset is your why. What drives you, and why are you doing all this?
Ooh, that's a good one. So a why can be a good and a bad. That's a why. And I say that, when it comes to my why, what is driving me is how I grew up. I don't want to be in that position. So that's what's driving me the most, is that I need to work extremely hard so I'm never in that position. My huge why is that when it comes to capital and when it comes to a net worth, the more money you have, the more people you can help. I mean, look at Bill Gates. Bill Gates just threw $100 million for this virus to help get a vaccine for it. So the more money you have, the more people you can help. So my goal is to achieve a certain net worth. And I've had a lot of people tell me I couldn't. I had a lot of people laugh at me. So that's also fuel to the fire. But I think that really fuels me is my bad why, because I never want to live the way I grew up. So that's pushing me to live the lifestyle that I want.
Fear can be a great motivator.
Oh, 100%. If you use it in that way. A lot of people don't. So if you can turn it into using it that way, it will be. I mean, if you look at my siblings, it looks like my apple fell far from the tree. I mean, it's, they don't have the drive that I do. They don't have the entrepreneurship that I do. They're happy and content with making $11, $12 an hour. And that's just them.
Like Tony Robbins says, people will move away from pain than they will to move towards pleasure.
Yeah, very much so. That's the big motivator. That's my big why. That's what's pushing me. That's why I wake up at 5, 6, 7 a.m. Lately, I've been working out every single day. That's until the gym's closed. That's what's been pushing me, and to grow a large company. My goal is to have this a multi-billion-dollar company. Every Wednesday, I have a Zoom call with my team because they're not all located in Charlotte as of right now, but they will eventually be located all in Charlotte and possibly South Florida if we decide to relocate there. But I told them, I said, my goal is to have this company as a 10, 15, $20 billion company. That's why I'm creating a fund this year, so we can achieve a 10 to 15, 20, $30 billion company company assets under management. And that's what's driving me, is because I want to achieve it. And I know the only way that I need to achieve it is I wake up and I do good to people and I create this and I buy good assets. I give good returns. And when you do that, people start to talk and more people are going to want to invest. And then that's when you just keep growing a massive company.
There's two really big key takeaways I just took. One, you're thinking big. You're trying to grow a multi-billion-dollar company. Like you said, you're not trying to get $10,000 of cash flow a month. You want 7-8 figures of cash flow a month.
Correct. 9 figures.
9 figures of cash flow.
Why not 10? Let's just make it 10.
Make it as big as possible. And then you are moving away from pain, like Fritz said. And that is just such an incredibly powerful driver. So thank you for sharing that with us.
For sure.
I think that provide a lot of value.
Yeah, anytime.
So I think you just need to get up at 4 a.m. That's when I get up.
So I technically do, because I have a newborn and he wakes up around 4:30 to eat. So I only sleep around 2 to 3 hours. Thankfully, my fiance and we take turns, but he decides to eat around 12:31 and then goes to sleep. He's definitely a motivational coach for me too.
I need to get on that 2-3 hour grind.
It's tough. I drank around 8 to 10 cups of coffee a day because I love coffee too. But yeah, it's definitely tough because there's sometimes you do have to take a siesta because you need your brain to, soak in as much information, and your brain's a muscle. So you need for it to rest. You need to give that time where you're not always focused on work, which that's my Sundays. My Sundays, I like to, spend time with family, watch movies, documentaries, because sometimes you need your brain to think funny stuff and to look at, kid stuff to really then reboot your brain and reload it. So when it comes to the week, you're powerful.
I think we are running out of time. I wanted to transition to our section called the Fast Five. It's the same 5 questions we ask each of our guests as they come on the show. So ready? All right, let's get right into it. So if you had to start all over again, and let's say you were 20 years old, what would you have done differently?
Oh, that's good. I would hire Coach Day One.
Very good. How do you see young professionals adding the most value to experienced operators in this space?
I like that one. When it comes to no numbers, the whole world's numbers. If you look how long this recording is, it's numbers. Everything's numbers. So if you don't know numbers, get to know numbers. Don't tell yourself you don't know numbers. If you say I'm bad at math, then you're going to be bad at math. If you say you can't read, you can't read. Throughout high school, my teachers would call me dyslexic, but I was shocked about a month ago. I read a 300-page book in 3 days. If you got me 7 years ago, I'd be in special reading classes because they trained my brain telling me I can't do it. So if you're not good with math, be good with math. Learn how to underwrite. That's a big way to add value to people's underwrite. Hey, I'll underwrite your deal for free, and just keep underwriting it. If you want to go another route, find good deals. Go out there, build relationships with brokers, find good deals, and present good deals to operators.
Great tips.
What's the biggest mistake you've made so far in your career, and how have you since adjusted your business?
Biggest mistake, trust is hard for me. And I would say, but you got to give trust. I trusted the wrong individual and they took money from me, a large amount. I ended up pivoting and was able to, keep everything afloat, keep it all good and running and operating very well. So I would say trust is very important when it comes to business partners, but you never know, people may find somewhere else or people may do bad to you and hurt you. So I would say that was something really making sure I could have probably done a better job interviewing and going more in depth about it.
So what's been your favorite way to incorporate technology and social media into your business?
I like that one. So social media is everywhere. It's not going away. How many people are on social media? Across all platforms, hundreds of millions, billions probably. Yeah, with all platforms. So it's not going away, and it's an easy way to get a hold of people. Why do you think Trump won the presidency in 2016?
Because he has a Twitter.
Correct. He used social media because everyone's on social media. And I don't understand why the media gets mad at him saying, why do you tweet everything? Because that's how we That's how we communicate these days. If I want to know your birthday, Facebook's going to say, oh, it's your birthday. So I'm going to say happy birthday to you. So, the social media is the forefront of everybody knowing everything. So using that to our advantage is pouring out great content that's going to help people, showing that you really care and you're really sincere on there helps tremendously. And that's how you grow a large business through social media. Look at Grant Cardone. Excuse me, I don't agree with some of the things he says. Some of the things I do agree with what he says. But look, he's grown a large social media company that was able to fund all of his funds. So,
and everyone's heard of Grant Cardone.
Yeah.
So last question. What's the most influential book or documentary that you've watched or read?
I may need to send you a PDF of all of them I've watched or read because there's a ton. I mean, I can name a ton. Documentary, which I watch over and over and over, is Warren Buffett. You can actually find it on YouTube. I watched that over and over. I love watching him, and I always get golden nuggets out of it. Also, The Men Who Built America. I love that. So those are the two. I can name a lot more, trust me, but definitely go check out those two. When it comes to books, I'm just looking at my books right now. I like Howard Schwartz about Starbucks. I also like, my real big one is, or three of them, is Grit. I like Grit. I like The Mistakes Millionaires Make. That's a really good book because that explains how individuals built a huge net worth, $100, $200, $300, $600 million net worth. They lost it all in just a couple months and then they gained it all back. So it really digs deep into their experience, why they lost it, what they should have done differently. So it definitely helps. And then Crucial Conversations. That's a good book, and you can find that one on Audible too. But Crucial Conversations will help you have large conversations with people during good times and bad times.
Those last two books, I was going to say, that just added to my want list.
All right, Chris. Well, thank you so much for coming on the Millennials and Multifamily podcast today. Before we go, what would be the best way for our listeners to get in touch with you?
Yeah, thank you so much. So we're getting our website back up and running, but you can go ahead and find me on social media. I have a closed Facebook group with everybody. It's called the Mindful Multifamily Network. I also have a Instagram, which is Chris_Salarno_. Email me directly at chris@qccapitalgroup.com.
All righty. Well, thank you so much for your time, Chris. And that is all.
All right. Take care. Thank you.
Thank you for listening to the Millennials in Multifamily podcast, brought to you by Kronos Investment Partners. If you enjoyed the show, please leave us a rating and a written review at iTunes so that we can connect with more people. Finally, head on over to kronosinvestmentpartners.com and sign up for our newsletter so you can stay updated on everything we're doing. If you're interested in partnering with us as we find new opportunities, you can also schedule a phone call with us under the Contact Us tab at kronosinvestmentpartners.com.